Would you agree that at every point in time, the resources owned by a business in terms of assets is always equal to the liabilities of the same business in terms of owings by the business? Well, as important as it is to report the activities and the financial positions of a business, it is also very useful using simple equations to express the activities of a business and the financial position of the business. This approach in giving insight in the activities of a business and the financial position of the business will take us to the accounting equations. Accounting equations is a way of expressing the activities of a business or the position of a business in simple arithmetical words or expressions or languages. Now, looking at accounting equation for income and expenses. Now, accounting equations for income and expenses are equations showing how a business is performing in terms of earnings or revenue. For instance, profit is a function of turnover and the cost of an item. Say, for instance, I deal in sanitizers. This sanitizer has a cost for buying it. And if I have to sell, there's a price for selling it. So the profit on this sanitizer is a function of the turnover, which is the selling price, and the cost, which is the cost of buying it. So what I am trying to say is that arithmetically, we can say profit is equal to turnover, which is the same thing as what? Sales minus costs, which is the same thing as what? Cost of the product sold. So if we have established that profit is equal to turnover minus costs, then we can as well express the same equation as what? Turnover is equal to profit plus cost. We can as well say cost is equal to what? Turnover minus profit. You know, this is useful when we're trying to get values from an incomplete record. But basically, what we are trying to establish here is that for profit to be expressed in a simple equation, we need the turnover, which is the sales or the selling price of the item, and the cost of the same item. That is what is expressed here. Turnover minus cost. Turnover here is the same thing as sales. Cost is the same thing as what? The cost of the product what? Sold. Having established that profit is a function of turnover and cost, which is the same as saying turnover minus cost, we must also understand that turnover has items affecting it. Same example. We are still dealing in sanitizers. We buy and sell sanitizers. Remember, the turnover is the selling price of the sanitizer. And then when we sell these sanitizers, maybe you sell like 50 units or 70 units. The sales is the selling price of 1 unit by the number of units what? Sold. Say, for instance, if the selling price of the sanitizer is, say, 10,000 for the sake of argument, and then if we have sold 4 units, it means the selling price or the sales of sanitizer will be 40,000. Now it is possible that out of the 4 sold, 1 will be returned back to us, thereby reducing the number of units sold to what? 3. Now in accounting terms, that one returned to us is what we call returns inwards. So it means that it's an item that can affect our sales. That is what? Returns what? Inwards. So going back to our equation, we can decide to what? Expand our turnover, since we can have an item affecting sales. So if we are selling, it's possible for us to have returns. So it means that turnover can be expanded to what? Sales minus what? Returns inwards. For that return inwards, returns made out of sales. Say you sold 4 units and then they return 1. So that means the sales will reduce to what? 3. So if we expanded turnover to sales minus return inwards, then it means that what? The equation for the profit can be expanded as what? Turnover, which is sales minus returns inward minus cost. Having established that the turnover can be expanded to sales minus returns inward, and then the profit, equation rewritten as what? Sales minus returns inward minus cost. The costs of an item also have certain other variables affecting it. The same instance, we are still dealing in what? Sanitizers. Remember, for us to sell the sanitizers, we have to buy from somewhere. That means the cost of an item is also a function of what? The purchase value of the same item. So that means that when you purchase the product, it is also possible to spend money to bring the product to the point where we sell it. For instance, the cost of buying the sanitizer might be, say, 5,000. Remember, we sell it at 10,000. Now, aside from buying it for 5,000, it's also possible that we spend another 500 to transport it from the point that we bought it to here that we are selling it. That's carriage inwards. So it means that the cost can have variables such as what? Purchases, which is the cost of buying the item. Carriage inward, which is the cost of bringing the item to this place. Now, after bringing the item to this place, it means that it is also possible that we return some back to where we bought them due to maybe wrong specification or damages. So that's what we call returns outwards. So it means that what? Our cost can be expanded into what? Direct costs and indirect what? Cost. The direct costs is the costs that is directly related to what? Getting the product that has been sold. What is the cost directly related to getting the sanitizer we are selling? The purchase cost of it, the cost of transporting it to this place, and any return made back to where we bought it from. So it means that our direct cost can be expanded into what? Purchases, carriage inwards, and what? Returns what? Outward. Now, what are indirect costs? Indirect costs are costs incurred but not related to the cost of getting the product. We are still on the sanitizer. We have established the direct costs involved in getting this thing down here to be what? Cost of purchasing it, cost of bringing it here, which is carriage inwards, possible returns back to where we bought them from. These are related to bringing this thing here. But remember, it is possible for us to have a warehouse. It's possible for us to advertise. It's possible for us to do insurance. It's possible for us to pay salaries. These are not directly related to bringing this product here. So these are part of indirect what? Cost. So back to our equation. The indirect costs can involve office rent, can involve salaries, can involve advertising, can involve warehousing, can involve interest, as if we have to borrow money, can involve tax. Now, it means that we have expanded our cost into two, direct cost and indirect cost. We also expanded our direct cost to be, elements such as purchases, carriage inwards, and return outward. And now we expanded our indirect cost to be elements such as what? Office rent, salaries, advertising, warehousing, tax, interest, and so on. Now, having established that our turnover can be expanded and our cost can also be what? Expanded. So we can rewrite the profit equation that was simply turnover minus cost as what? Turnover broken down into what? Sales minus returns inwards minus what? Costs, which can be direct costs, broken down into purchases plus carriage inward minus returns outward. Now minus what? Indirect costs, which is other expenses such as rent, advertising, warehousing, insurance, and so on. So it means that a simple equation, which is turnover minus cost, has been expanded to what? Sales minus returns inward minus direct costs minus what? Indirect costs. Direct costs broken down to purchases plus carriage inward minus returns outward, and then indirect costs involving other expenses not related to the what? Cost of getting the product, such as what? Advertising, warehousing, salaries, tax, and so on. Now we have established that profit is equal to what? Turnover minus cost. We have also established that turnover can be expanded, sales minus returns inward. Cost can be expanded, direct cost, indirect cost. Direct cost can be expanded, purchases plus carriage inwards minus returns outward. Indirect cost can be expanded to rent, advertising, warehouses, tax, interest, and so on. Now, the profit can also be expanded. We can expand our profit to either gross profit or net profit. Now, your gross profit is a function of your turnover and direct cost. So it means that the turnover minus the direct cost is your gross what? Profit. What's your turnover? Expanded. Sales minus returns inward. What's your direct cost? Expanded. Purchases plus carriage inward minus returns what? Outward. So your expanded turnover minus your expanded direct cost is what we call gross profit. Now, the next one is net profit. Net profit is a function of your gross profit and the indirect cost. What are the indirect costs? Indirect costs are expenses such as what? Rent, advertising, warehousing, insurance, tax, interest, and all that. So your net profit equation can be written as what? Gross profit minus indirect cost, which is other expenses. So gross profit and net profit is an expansion of what? Profit. So gross profit equation is what? Your turnover, which has an expansion, minus your direct cost, which has what? An expansion. Your net profit equation is your gross profit minus what? Your indirect what? Cost. Now, aside from the established expansion of profit to gross profit and net profit, there are other nomenclatures or taxonomies of profits, depending on what? On industries. But know that they are profits, despite the name they are giving it. You can hear something like earnings before tax, which is EBT, or profit before tax, which is PBT. Now, the equation for earnings before tax or profit before tax is simply your what? Your gross profit minus your indirect cost. What are indirect costs? Remember, expanded, we have things like rent, advertising, warehousing, interest, tax, and all that. But because you're looking at earnings before tax, it means your gross profit minus your indirect cost, excluding your what? Tax. So it means that where you're trying to create a formula or an equation to take your gross profit into consideration against your what? Other expense or your indirect expense, you must exclude what? Tax from the equation. So where you are excluding tax from the equation, you are trying to what? Arrive at what? Your earnings before tax or your profit before tax. Another nomenclature is earnings after tax. As the word implies, in this case, you're including tax in the equation. So it means gross profit minus indirect costs. What are indirect costs? Expanded: rent, advertising, warehousing, interest, and tax. Where you include tax in the equation, you are trying to arrive at what? Earnings after what? Tax. The next one is EBITDA. EBITDA means what? Earnings before interest, tax, depreciation, and amortization. Well, we already know what tax is, and what is depreciation? Depreciation is the part of what? A fixed asset or a non-current asset that has expired in an accounting year. If you have a motor vehicle, you might decide based on policy to use it for over 4 years or 5 years. So every year you write a particular part of it off as an expense. So that part is what we call depreciation. So amortization is the same thing as depreciation, but just that it is used for other assets other than what? Assets that are permanent in nature. For instance, if you pay for leasing, say you lease a particular place for like 10 years, you cannot depreciate that, you amortize that. So it's the same thing, but we use them under different condition depending on the nature of the asset. Okay, so you can go back to the class for assets, and understand that. So, but here we are trying to get an accounting equation for earnings before interest, tax, and depreciation and amortization, also called EBITDA. So we say gross profit minus indirect costs. What are indirect costs? Other expenses such as what? Rent, advertising, and all that. In this case, you are excluding interest for any borrowings you made. You are also excluding tax. You are excluding depreciation and amortization from the what? From the equation. So where you're taking this item from the equation, you're trying to arrive at what? EBITDA. The next one is what? EBIT, which is earnings before interest and what? Tax. So it's the same thing, gross profit minus indirect cost. But in this case, you are excluding what? Tax. Okay? Okay, so that is what we call earnings before interest and what? Tax. So we understand all the nomenclatures from earnings before tax, earnings after tax, earnings before interest, tax, depreciation, and amortization, and EBITDA, and then earnings before interest and tax, which is EBIT. Here in EBIT, we're saying gross profit minus indirect costs, excluding interest, tax, but including depreciation and amortization. So here we are looking at what? Equation for assets and liabilities. This is where we formulate equations, simple equations actually, for what? The position of the what? Business. And I've already said it, that at any point in time, your asset or resources that you have must be equal to the debt that you are owing. So whatever you have at any point in time as a business must be equal to what you are owing at that point in time. So let's try to look at what I'm trying to say. Now, if we have established the fact that total assets, which is your resources that you have, is equal to your total liabilities, that's the accounting equation here. It means that your assets must be equal to your what? Liability at every point in time. So now we have established that our assets at every point in time must be equal to our liabilities. Our asset has variables. So let's expand our assets. Our asset is a function of non-current assets, which we also call fixed assets by our local standard here in Nigeria. And then we have current assets and other assets. Non-current assets are, as I already said, are called fixed assets. Examples, you have land, building, motor vehicle, equipment. So if the business has items like this, a combination of all of them is what we call non-current assets. So we can formulate an accounting equation for non-current asset as what? Land, building, motor vehicle, equipment, and so on. Having established an expansion of the non-current assets, so let's look at the current assets. Current assets are items in the form of cash or that are easily converted into cash in the normal course of business. We already have a class on that. But in formulating the accounting equation, there are variables that determine the current assets. For instance, we have cash in hand, cash at bank, debtors, inventories. So we have all these items. A combination of all these items will form the equation for what? Current assets. So we can say our current asset is what? Cash in hand plus cash at bank plus debtors, inventories, and so on. So we already established that our asset is a function of what? Non-current assets, current assets, and other assets. We established that non-current assets are fixed assets. Current assets are assets are not permanent in nature, they're in form of cash or can be easily transformed into cash within the ordinary course of business. But other assets are items that take the nature of an asset due to the peculiarity of the transaction. Take, for instance, a huge amount of money paid to seal patent for an invention. You can write that off at once. So you write that off, gradually. You understand? Goodwill, for instance, if during a particular acquisition, you had, a sort of expertise that was valued, as an addition to what? To the business, based on certain agreements or standards, such item can be treated as an asset written off over a period of time. So when you have such kind of assets, we call them other assets. So a function of those assets will determine your other assets. So if we are taking goodwill and patent as an example, so it means that your other assets can be written as what? Goodwill plus what? Patent. You understand? So if you have other, like copyright, for instance, is huge. It can also form part of this other asset. So once there is a cost that takes the nature of an asset due to the peculiarity, we classify them as other assets. So now we have established that assets can be expanded into non-current asset that also has an expansion, current asset also has an expansion, and other asset also has an expansion. So if our total asset is equal to non-current asset plus current asset plus other asset, then it means we can arithmetically put the accounting equation as total assets, which is equal to non-current assets, that is land, building, motor vehicle, and all that, plus current assets, which is cash in hand, cash at bank, debtors, inventory, and other, plus other assets, that's goodwill, patent, and so on. So that is the expanded total asset equation. Now, let's expand our liabilities. We already know that our liabilities are the debt that the business is owing others, okay? So, liabilities are a function of what? Long-term liabilities, short-term liabilities, and owner's equity. Now, the long-term liabilities are debt of the business that are payable over a long period of time. Say bank loan, debenture, bonds, and all that. And then that means we can write an equation for long-term liabilities using the items that affect it or that determines it. So we can say our long-term liability equals to what? Bank loans plus debentures plus what? Bonds. That's an arrangement where you try to raise money, for the business. Okay, I'll look at that in some subsequent classes. It's a huge one. Now, having established an equation for long-term liabilities, we can as well expand our short-term liabilities. What are short-term liabilities? Liabilities that are payable within a short period of time, usually the accounting year, say bank overdraft, trade creditors, unpaid taxes, unpaid dividends. Okay, so it means that we can also establish an accounting equation for short-term liabilities. We have bank overdraft plus trade creditors plus unpaid taxes plus unpaid dividends and other items that fall within that category. Now, what is owner's equity? It's more like capital. Now, as a business, remember, someone floated the business with an amount of money or resources. Now, due to the separate legal entity, we must understand that a business is an artificial person, different from the owner. So at every point in time, the business is seen as a debtor to the owner. So it means that at every point in time, whatever the owner has invested into the business is what the business is seen to be owing the owner. So we call such owners what? Equity or what? Capital. Now, after investing into the business runs, does one activity or the other, and then makes profit. So that profit that the business made technically also belongs to the what? Owner. So it means the equity can increase or decrease. If the business makes profit, the equity will increase by the profit made. If the business makes loss, the equity will reduce by the loss made. So it means that a profit is a function of what? Of owner's equity as well. So it is also possible for the owner to take out some maybe items and use it for himself, or take out money, use it for himself. We call that drawings. In limited companies, we use director's current account. It's the same thing, just that it's varying based on industry and the type of business. But that's a discussion for another class. So basically, we can say that the owner's equity can have its equation as what? Capital plus profit minus drawings. Capital is the initial amount that has been invested into the business. That is what the business is owing the owner. So if I float a business with 1 million, it is known that the business is owing me, the owner, 1 million. So that 1 million is my equity in the business. But if the business makes a profit of say 200,000, technically my equity is increasing to 1,200,000. That's why you're adding your profit here. But if in the course of the business year I took out some money as well, or some products, that should also affect my equity. So that's how we have the owner's equity equation to be what? Capital plus profit minus what? Drawings. Having established an expansion of long-term liabilities, short-term liabilities, and owner's equity, so it means we can arithmetically write what? An accounting equation for what? Total liabilities. So total liabilities will be equal to what? Long-term liabilities, which has been expanded to what? Bank loan plus debentures plus bonds, plus short-term liability also expanded to what? Bank overdraft, trade creditors, unpaid taxes, unpaid dividends, and so on. Then plus owner's equity expanded to what? Capital plus profit minus what? Drawings. So we can say that what? Expanded total liabilities at every point in time must be equal to what? Expanded total what? Assets. Now here is a simple illustration. It says fill in the blank spaces in the table below. We have capital, here are the items. We have assets, here are the items. We have liabilities, here are the items. The first item says capital 250,000. Assets is what? Blank. Liabilities is what? 730,000. Remember our equation. Your assets must be equal to your liabilities. And then your liabilities is a function of what? Long-term liabilities, short-term liabilities, and owner's what? Equity. So technically, your liability here, your capital here is part of what? Of the liability. So we can say asset is equal to liabilities plus what? Capital. So in this question, we have capital, we don't have assets, we have liabilities. So if asset is equal to liabilities plus capital, it means our liability plus our capital is equal to our what? Asset. So 250,000 plus 730,000 is equal to 980,000. That is what we've done here. This is the solution. The next one says capital is blank. We have assets, we have liabilities. So how do we find the capital? If we have established that asset is equal to liabilities plus capital, and we are looking for capital, so let's make capital the subject of the formula. So leave capital here, let liability come to where asset is. Liability is positive here. If it crosses the equation sign, it turns negative. So it means that our capital is asset minus liabilities. So what is our asset? Our asset is 890,000. What's liabilities here? 650,000. So asset minus liability is equals to what? Capital. So 890,000 minus 650,000 gives us 240,000. The next one here is what? Capital here, we have it. Asset, we have it. We don't have liabilities. We know the equation. Asset is equal to liabilities plus what? Capital. So we're looking for what? Liabilities. So make liabilities subject of the what? Formula. So capital leaves this place, crosses the equation sign and comes here. If positive crosses the equation sign, it turns to negative. So that means our liability to be what? Asset minus capital. So what is our asset? 975,000. What's our capital? 385,000. So 975 minus 385 gives us 590. That's what you have here. The next one says capital 450. Asset, we don't have it. Liability, we have it. So we already know the formula. Asset is what? Liabilities plus capital. So 689 plus 450 gives us 1,139,000. The next one, we have capital, we have asset, we don't have liability. We already know the formula that liability is what? Asset minus capital. So 560 minus 340 gives us 220,000. The next one, we have asset, we have liability, we don't have capital. Capital is what? Asset minus liability, which is 890 minus 585,000. That gives us 305,000. Check out the part 2 of this topic for a further illustration.